Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. Let's take a look at what happened overnight. Rising bond yields have weighed on global equity markets as expectations of aggressive monetary cuts ease. Stronger than forecast US economic data has investors reassessing the outlook for interest rates. That, along with uncertainty around the Middle East conflict, weighed on sentiment on Wall Street, with the major indices finishing lower and the CBOE volatility index hitting its highest level in a month. Stock, specifically Amazon, proved to be one of the biggest drags after a Wells Fargo downgrade, and AI server super microcomputer shares surged as it said it had recently deployed more than 100,000 GPUs with liquid cooling solutions, some of the largest AI factories ever built. And shares of Pfizer rose after a report that activist investor Starboard Value had taken a roughly $1 billion stake in the pharmaceutical giant. US-listed shares of Arcadium Lithium jumped following news that Rio Tinto is in takeover talks with the minor US-listed shares of Rio. They finished lower, whereas BHP rose. And Goldman Sachs has raised its 2024 year-end for the S&P 500 to 6,000 from 5,600 and lowered its odds of a US recession to 15% from 20%. Well, the benchmark 10-year Treasury yield has topped 4% for the first time in 2 months as markets bet against another 50 basis point rate cut in the US. This comes after September's stronger than expected US payrolls report fueled expectations the Fed will dial back its aggressiveness in cutting rates, with the US economy adding more than 250,000 jobs last month while the unemployment rate fell to 4.1%. The 10-year yield rising to 4.02%, the 2-year reaching its highest since mid-August at 4%. And the US dollar is near a 7-week high as investors reassess their positions following the stronger than expected economic data and also amid rising tensions in the Middle East. Hezbollah rockets have hit Israel's third largest city of Haifa on the first anniversary of the Hamas attack on Israel. And the Aussie dollar, it is at 67.5 US cents. So taking a look at commodities, oil prices have continued to rise, up another 3% overnight, with Brent surpassing $80 a barrel for the first time since August on the increased risk of a region-wide conflict in the Middle East. The base metals are broadly high, although copper's off around 0.5%. Iron ore up close to 3% at $111 a tonne, and the gold price has eased to $2,642 an ounce. Bitcoin, meanwhile, that has moved above 63,000 US dollars. All right, let's get across what we're seeing, particularly stateside. Steve Sosnick, he joins us from Interactive Brokers. Steve, welcome back. Good to talk to you again. Let's take you back then to Friday with that payrolls report. What was and we've certainly seen the outlook for interest rates has changed, hasn't it? That we're seeing that underlying strength in the jobs market. So the question being, why would you need another aggressive rate cut?
Morning, Andrew. Short answer to your question, beats me why we need another one, but the market remains hopeful. I think, remember here, the Chairman Powell went out of his way, even after cutting rates 50 basis points, in that same press conference saying, don't expect rate cuts of this size unless we need them. And we don't need them, at least based on this report. And so you saw the market really recalibrate its opinion about rate cuts. We went from sort of a 35% chance of a 50 basis point cut to a 15% chance of no cut, the balance still being the 25 basis point cut. But if we get another print like this, it's hard to imagine that we get anything more than that. Yeah, that was my take, minutes after the report came out, and that seemed to be the case. The market really tended to agree with the idea of nothing bigger than 25 basis points, and we'll see if that's even necessary, because we get CPI and PPI this week. The monthly hourly earnings portion of the labor report showed 0.4% monthly growth, which is hardly compatible with 2% inflation. So if you've got a situation where you don't need to cut rates because we're kind of back flirting with maximum employment portion of the maximum employment portion of the mandate, and then we're still not 100% out of the woods yet in terms of the stable prices portion of the mandate. What do you hope? Based on what would you be hoping for a 50 basis point cut? I don't see it right now.
So, how do you see the equity market reacting, those investors? I guess they've got to consider the strength of the US economy, but also the fact that there'll be perhaps fewer rate cuts.
Well, in general, I've said this, many times, and you and your viewers have heard me say it before. When given the choice between rate cuts and a strong economy, equity investors should always root for the stronger economy, and that I feel very strongly about. So, but right now, equity investors, particularly in the U.S., are in such a buoyant mood that bad news is good news because rate cuts are coming. Good news is good news because the economy's strong. I made a joke today that if Martians landed, somehow that would be good news because we could export globally, probably. Who knows? But that's really kind of the market mentality is really is really quite frothy right now, despite the fact that we went down today. But of course, bear in mind that all we did today was give back Friday's gains, most of which came in the last hour of trading anyway. So, I don't want to read too much into it. I do think the markets, as you mentioned with that VIX spike today, I think they're becoming a bit more cognizant of the risks that might come down the pipe in the next 30 days. Remember, VIX is a 30-day look ahead, the market's best estimate of volatility over the coming 30 days. Just this week, we have PPI and CPI. We have the start of earnings season, where I think guidance is going to be very important. You're going to have another jobs number within the next 30 days. And oh, by the way, we're going to have an election in the midst of that. And we're just like 31 days from the next Fed meeting. So there's a lot of volatility coming down the pipe, not to say the least, tensions in the Middle East and a giant hurricane bearing down on Florida.
Goodness, that is a long list to consider, Steve. No wonder the volatility index is spiking higher. But just back to the economy, do you think so? Are investors now discounting any possibility that there will be a recession?
I think the idea of soft landing came very much into play. And again, I tend to take my economic cues from the bond market, and the fact that 2-year yields, are up basically 30 basis points in the course of 2 days. The 10 years are not up quite so much. I think it's about 18 or so. We actually briefly reinverted for like a hot second today between the twos and the tens, although now it's about it was ended up being about 3 basis points or so. But remember, the problem isn't so much the inversion, it's coming out of the inversion. The recessions tend to start when we normalize the yield curve after an inversion. So I think that's another sign that at least the bond market is, telling us to expect something, not telling us to expect a recession imminently, and that's pretty much what the jobs numbers told us. Is hiring continues solidly. People are getting hired, people are getting paid, and the unemployment rate went down a little bit to 4.1, which is a number that previous administrations would have killed for. So all this means that things are generally okay. And now we get the test. Well, we will get the test starting next week, really. Are the valuations that are being priced in, is the guidance that's being priced in to commensurate with the type of the economy that corporations are seeing right now.
Steve, I noticed your headline from last week saying, "Don't get too distracted by geopolitics." Of course, given what's going on in the Middle East at the moment. You've made this point before that particularly the US equity market doesn't really move in response. Nonetheless, certainly the energy complex is, with oil continuing to spike higher. How are you viewing that at the moment?
Well, that's always my one exception. Bonds and oil do tend to need to pay attention to geopolitics because bonds are the beneficiary of a safety trade. And if there are concerns in oil producing regions, and by the way, the same goes for any commodity. If there's disruption in a place where the commodity is mined or drilled for, et cetera, they tend to know. Now, one of the anecdotal things I'd heard was there's a lot of what they call tourists in the oil trade right now. People just, remember, we've all become momentum traders. We're basically just trend trading addicts right now as far as people go. And so you got a little momentum in oil. I don't know if that's being overdone or not. Certainly, I can understand why tensions are high. I mean, it's hard to imagine that Israel doesn't do anything to Iran in response for having missiles lobbed directly at it. And so this is a very fluid situation, and certainly one that with a range of negative outcomes. By the way, and if we have a sustained oil price rise, then we're talking about something inflationary as well, and then you might even be able to kiss 25 basis point cuts goodbye. But this is one of the unknowables, and I will say that oil tends to be one of the places I look for the market's reaction, and the fact that I have seen it spike does make me think that people are taking it seriously. But also, let's keep in mind that it's really basically back to the average levels that prevailed all year. So I can't take too much away in one direction or the other from this bounce.
Steve, always great to get your perspective from Interactive Brokers. Thanks for joining us.
Thank you so much. Take care, Andrew.
Check at where we're likely to start. So a pretty flat opening expected when we take a look at SPY futures. They're about 4 points lower. All eyes are going to be on China today. The markets are reopening there with forecasts that those very impressive gains we've seen of late will continue. So join us as we get going in just a couple of minutes' time.